everyone, Farhan here. So today you'll solve question 4 from 2014 past exam. In this question, you will prepare the classified balance sheet for a new business. You will see the question on the left-hand side of your screen, and on the right-hand side, you'll see the workings. With that being said, let's begin. Chris Stone established a small business, Willow Terrace, to sell outdoor furniture. The business will use control accounts and subsidiary ledgers for both debtors and creditors. The business officially commenced on 1 June 2014 with the following transactions and information. So here you can see we're given a list of transactions, and you are required to prepare the classified balance sheet for this new business on the first day of operations, which is 1 June 2014. So let's look into the workings, starting with the first information that we have. A check for $40,000 from Chris Stone was paid into the business bank account. Now, this is referring to the initial investment that has been made by the owner. So the owner started the business with $40,000 in capital. This means when capital increases for the business, we have to credit it. And because we have invested this money in the form of funds deposited into the bank account, this is increasing the balance of the bank account, and therefore we have to debit back, because when assets increase, we have to debit them. So although we are not required to do the journal entries, we are going to understand in most cases how to journalize for this specific type of transactions, so we can understand how to use them within the balance sheet, which basically depends on the accounting equation of assets equal to equity plus liabilities, or assets equal to capital plus liabilities. All right, so let's move into the second additional information that we have. A business loan of $20,000 was received from any bank. The loan is repayable in equal monthly installments over 24 months. An overdraft of $50,000 was also arranged. All right, so we have taken a loan on the first day of operations, and that loan is $20,000. We know that we will pay this loan equally over 24 months or over 2 years. So although the question says that we will pay equal monthly installments, this is the same thing as saying that we will pay off the loan in equal amounts every year, right? So this loan will be paid off over 2 years. So how are we going to pay off this loan over 2 years? So the $20,000 will be paid off in $10,000 in the next 12 months, right? And because this is repayable in the next 12 months, this falls within the category of current liability. So when you prepare the balance sheet, within the current liability section, you have to show loan of $10,000, which basically reflects that this business is supposed to make a payment of $10,000 in the next 12 months. Then the other $10,000 is going to be repaid at the end of 24 months, which is at the end of 2 years. And because this is after 12 months, this is no longer a current liability, but rather a non-current liability, which refers to an obligation which is not due within the next 12 months, but after the next 12 months. And in this question, it is due at the end of next 24 months. All right. So therefore, when you prepare the balance sheet, within the non-current liability section, show a loan of $10,000, which reflects the repayment to be made in 24 months. And then again, also show loan of $10,000 within the current liability section, which reflects the repayment to be made in 12 months. All right. Okay. So what about the last sentence? An overdraft of $15,000 was also arranged. So this is arranged, not taken. This means that in the event the business needs money instantly because the business doesn't really have anything else to survive, then the business is able to access $15,000 from the bank as a short-term loan. So that is what we understand by the overdraft. So this is an arrangement in place. This doesn't necessarily mean that this has been taken. So therefore, we do not have to include this within our preparation for the balance sheet or the journal entries. So let's look into the third additional information with regards to rent. So a 3-year rental agreement was signed. Rent of $5,000 was paid for the 3 months to 31 August. Willow Terrace paid a security bond of $4,000. That security bond will be refunded to Willow Terrace at the end of the rental agreement, provided that the premises are in satisfactory condition. All right. So to begin with, we understand that we have signed a 3-year rental agreement. And on the 1st of June 2014, we have paid $5,000 of rent, we can say that we have prepaid rent because we are on the first day of operations, which is on the 1st of June 2014. And this rent of $5,000, which we have prepaid, it covers the entire month of June, the entire month of July, and August. So this is valid for 3 months. Now, this is what we would classify as a current asset. Why is that so? Because there are some economic benefits which are worth $5,000 for the rent that we have paid in advance on the 1st of June 2014. And over time, as the months go by and we consume the rent by utilizing the space for our business operations, we would be incurring the expense. So this would be expensed gradually over the next 3 months in June, July, and August. Okay, so that is why at the moment, if you are preparing the balance sheet on 1 June 2014, this is still a current asset because all the economic benefit is still there, which is $5,000. Now, a lot of students forget to record the GST part. Now, the rent that we are signing here is dependent on business operations, right? So this is referring to a commercial agreement, like this agreement that we have entered with our landlord as a tenant. This is referring to commercial purposes because we're running a business. So obviously GST should be included in this case. So when we're prepaying $5,000 of rent, we also have GST of $500, which is 10% of this amount. Now, this GST that we are paying is what we would show on the debit side of the GST clearing account to reduce our obligation or our liability, which we have with the ATO. Now, we will come back to GST at the end when we do all the calculations. So what about the security bond of $4,000? This forms the definition of a non-current asset because we are receiving this at the end of the next 3 years. So even in Australia, when you are renting a house, so you have to pay a security deposit, right? So when your lease expires and you are about to move up, you can get that deposit back. So this is something similar to that, but this is for commercial purposes. And because the rental agreement is for 3 years, this security bond would be refunded back to the business at the end of 3 years. And at the moment, this can be treated as a non-current asset because we have this economic benefit that is stored somewhere, but we cannot access it within the 12 months that are coming next. Therefore, we cannot call this a current asset, but we can access it after 3 years, and therefore we can call this a non-current asset. So when you prepare the balance sheet, you need to show the prepaid rent within the current asset section and the security bond within the non-current asset section of $4,000. All right. So we do not really have any GST with the security bond because this is not referring to the operations at the moment. This is just there so that we can protect the premises from any damages. So if there are any damages that are made to the premises during the course of business operations, this security bond would be used to recover those damages. So there is no GST involved here because this is not a good, not a service. All right? Okay. So what about transaction 4? Chris's own motor vehicle, valued at $24,000, was also contributed to the business. It originally cost $52,000 plus GST. All right. So when Chris purchased this motor vehicle for personal uses in the past, Chris paid $52,000 excluding GST. But today, on 1 June 2014, Chris decided to contribute his personal motor vehicle into the business. So this means that Chris has contributed some motor vehicle in the form of capital. But the but whatever Chris paid when Chris first bought it for personal use is not relevant at all in this case because of the business entity assumption. All right. But today, on 1 June 2014, this motor vehicle has a carrying amount or a fair value of $24,000, which refers to the economic benefit that is available within this motor vehicle so that the business can utilize it for generating revenue and run their operations. So when you're recording the motor vehicle in the business's books, you need to record it at the value that is valid on 1 June 2014, which is $24,000. So this is referring to capital contribution. And when capital increases, we credit it, as we have discussed in the first transaction, right? So we are crediting capital by $24,000. But at the same time, our assets are increasing because of the motor vehicle that we have contributed into the business. And that is why we debit motor vehicle by $24,000, because when assets increase, we debit them. And debiting motor vehicle by $24,000, this thing is needed to be shown as a non-current asset when you prepare the balance sheet, because the motor vehicle is going to be used for more than 1 year. All right. So let's move to transaction number 5. Shop fittings that cost $30,000 plus GST were purchased on credit from BFIT. And you can see the source document is the invoice. So this is invoice because it has been purchased on credit. There has been no payment of cash. So a deposit of $4,000 was also paid. And the reference in this case is the check number 3. So as we see from this thing here, we have 2 transactions actually. The first one being the purchase of shop fittings on credit. So let's record that. How would we record this if we were to do the journal entries? We would debit the shop fittings by $30,000, which basically reflects that assets are increasing. So when you prepare the current classified balance sheet, you need to show the shop fittings within the non-current assets section. Then you have GST that you have paid, and that is $3,000, which is obviously 10% of the original cost of $30,000. Now, every time you pay GST, we debit it. And the logic for that is that any GST that we pay, we can use that to offset our obligation for the GST collections with the ATO. Now, GST clearing account, where we record the GST payment and the GST collections, this account by default is a liability account, a current liability account in most cases, because normally the business will collect more GST than what it will pay. And that's how the business kind of makes profits on its sales and expenses and costs, right? So every time you pay a GST, it reduces the obligation with the ATO, and that obligation which is reduced, we need to debit it, because when liability goes down, we debit it. So we debit GST clearing by $3,000 to reflect that reduction in liability with the ATO. Then we are crediting other payables or sundry creditors, which is what you would see in the marking guide, because in the old curriculum we would call it sundry creditors, but you need to be specific. So the business that is involved here is BFIT. All right, so credit other payables BFIT or sundry creditors BFIT, and that is the entire amount of the shop fittings plus the GST, which is $33,000. Okay, so the first journal entry here says that assets are going up. The second journal entry here says that liabilities are going down because we are debiting GST clearing. And the third journal entry here is saying that liabilities are going up, mainly a current liability, which refers to other payables. And you have to be very specific when you use this in the balance sheet. You need to mention other payables BFIT if you want to get the full marks. Okay? Excuse me. Then we are also making a payment of $4,000 to this business from which we purchased the shop fittings on credit. So when we're paying $4,000, our obligation with this business goes down, and therefore we debit that to reflect that reduction in obligation, because when liabilities go down, we debit it. So we debit other payables in BFIT by $4,000, and then we credit back, because that is obviously what we have used, the funds available in the bank account to settle this payment. Okay. So the final amount we will owe to BFIT is basically $33,000, which is $30,000 plus $3,000, the GST for the shop fittings, minus $4,000, the payment that we have made, and at the end we owe BFIT $29,000. Okay, so let's move to transaction number 6. Stock that costs $38,000 plus GST was purchased on credit from Exotic Gardens Limited. And again, you'll see it's an invoice as the source document, because we have purchased the inventory on credit. So when we are purchasing inventory, our assets in the business are going up, mainly the current assets, because inventory is a current asset and we would want to sell this inventory as quickly as possible. So when inventory is increasing, we are debiting it to reflect an increase in assets, mainly current assets, and we are also supposed to pay GST. Right? So again, we are going to pay GST, and every time we want to pay GST, it reduces our obligation with the ATO. And when our obligation goes down, our liability goes down, we debit it. So that is why we would debit GST clearing by $3,800. And then the total amount we would owe to our accounts payable. So see, I'm not writing others payable in this case because accounts payable here refer to credit suppliers of the business. So accounts payable of 41,800. Okay, so this means that within the current assets, we will report inventory of $38,000. We will report the GST that we would pay on this inventory as part of our final calculations. And then we would also show accounts payable of $41,800, which we owe to our credit suppliers within the current liability section. Okay. Now, what about the last information that we have? Stock was ordered for $15,000 plus GST from Far East traders in Singapore. Delivery is scheduled for 25 June. Right, so we haven't really received any items here, nor did we make any payment. Actually, we do not really have any specific information regarding the payment, but because the stock is ordered, we can expect that we haven't really received the goods, which they're saying we will receive it on 25 June. So at the very moment, we cannot really record anything in the books, right? Because there is no actual inventory that's coming in, nor is there any payment of cash that we have made to this company in Singapore. Right, so I like to believe that normally you would deal with transactions like this the day you get the delivery. That's when you can record this inventory in the books, right? Okay, now let's look into the outline that we have been given for the balance sheet. Excuse me. So I have already prepared this, and you will see that I've put question marks in most cases because these are the ones that we have to calculate ourselves. Now, obviously, the balance sheet is dependent on the accounting equation of assets equal to total capital plus liabilities. All right. So within assets, we have current assets and non-current assets, which is what you can see here. And then within liabilities, you have current liabilities and non-current liabilities, and then you have capital here. So within the current asset section, we have got a few elements to record. So we've got bank, we've got inventory, prepaid rent, and GST clearing. So GST clearing, as we have discussed before, is a liability account by default. But based on our calculations today, you would see that it is an asset because we have paid more GST, and it makes sense because it's on the first day of operations, right? So we haven't really made any sales yet to do the final calculations of any settlement that we need to do. And then within the non-current assets, you have security bond, you have motor vehicles, you have shop fittings. And then within the current liabilities, I've included the accounts payable, the credit suppliers, and the other payables, specifically BFIT, the business from whom we purchased a motor vehicle. Is it motor vehicle? Sorry, I think it's shop fittings. And then we have got the loan repayment of $10,000 in 12 months. And then under the non-current liabilities section, you have got the other loan repayment of $10,000 in 24 months. Okay, so let's start with the bank balance in the current asset section. All right, so first of all, if you want to find the balance for the bank, we have to start from the very first transaction we have. All right, so I believe you remember everything we have done so far in terms of workings today. So we have made an initial investment of $40,000. We can confidently say that, right? Then we know that we have received $20,000 in loan. Okay. So when you receive loan, your bank balance is going to go up, right? So $40,000 plus $20,000, $60,000 in cash inflows so far. Then we have made $5,000 payment for prepaid rent. That is what you can see in transaction number 3. But do not forget the GST on rent, which is $500, calculated as 10% of $5,000. And GST, although it wasn't explicitly mentioned in the question, you must remember that this agreement is signed between two businesses, and therefore this is for commercial purposes, all right? So therefore GST must be involved here. Then you paid security bond of $4,000, right? And then you have made a payment of $4,000 to the business from whom we purchased the shop fittings on credit initially. Okay, now altogether you have $46,500 as the final balance for the bank, and that is what we are going to report here. So 46,500. So let me just write that. Okay, so inventory is 38,000. which is what we have seen in transaction number 6. Prepaid rent is 5,000. We already know that. So what about GST clearing now? Okay. So I've prepared a ledger account for the GST clearing. Now we started with the initial transaction. So this is on the debit side and this is the credit side. Okay. So we have paid $500 for the prepayment of rent. All right. So we have paid 500 GST for that. And why is this on the debit side? As we have discussed earlier, this reduces the obligation that we have with the ATO. Now, when you think of GST clearing account, it is a liability account by default. All right, because generally a business that is making profit will be expected to collect more GST from sales and pay less GST on expenses and costs, right? So GST clearing account by default would be a liability account, which calculates the obligation that we have with the ATO. But because we're on the first day of operations, which is 1 June 2014, we do not really have any sales or any GST collected on sales. So all we have is GST paid, and any GST that we're paying is going to be reported on the debit side to reflect any reduction in liability that we have with the ATO. Now, starting with the first one, as we have discussed, is the GST that we pay on prepaid rent of $5,000, and that is $500 calculated as 10% of $5,000. Then we made a payment. We didn't really make a payment. Then we have GST of $3,000 relevant to the purchase of shop fittings on credit from BFIT. Okay, so if you recall 1, 2, 3, 4, 5, transaction number 5, you will see that shop fittings $30,000 plus GST, which is $3,000, were purchased on credit from BFIT. So that GST of $3,000 is also going to reduce the obligation, and therefore this is reported on the debit side. And then we have purchased inventory on the second last transaction of $38,000. And the GST on that would be $3,800, and that is required to be paid to our credit suppliers eventually. All right. So altogether, we would be paying total GST of $7,300. All right. So if we are paying more GST at the moment, this means that we have an asset because we do not really have any collections. So that is why you need to show this within the current asset section. Excuse me. And also, we do not have any opening balance for GST clearing account, as you understand that this is a new business. So the final balance for GST clearing, as we have calculated in this case, is $7,300. And this is only referring to all the payments we have made on 1 June 2014. Now, so for the non-current assets section, you remember the security bond, which we are going to get at the end of 3 years, and that is $4,000. You remember motor vehicle of $24,000, which we have contributed into the business. Then we have purchased shop fittings of $30,000, and altogether the non-current assets are $58,000 in total. And when you add the non-current assets with the current assets, you get $154,800. Now let's look into the current liability section. So starting with the accounts payable, we owe $41,800 to our credit suppliers. This was calculated through the purchase of inventory worth $38,000 and the GST of $3,800 that we would be paying. Then the amount that we owe to BFIT, from whom we purchased shop fittings, we have calculated the final amount we owe, and that was $29,000. So let's include that here. And then you got the loan of $10,000, which we expect to repay in 12 months. And altogether, the total of current liabilities is $80,800. Now, within the non-current liability section, you've got loan repayment due in 24 months, and that is $10,000 as well. And then capital is what we had to calculate ourselves. So what is the capital? So capital is referring to $40,000 of initial investment that we have made on the very first transaction, if you remember. And then we have contributed the motor vehicle. And the day we contributed the motor vehicle, it had a value of $24,000, which is the economic benefit left by the business to be consumed for generating revenue and in the course of business operations. Other than that, we do not really have any investment or capital contributions. So altogether, the capital comes out to be $64,000, which is what you will include here. So let me include that here. Right. So when you add the total of current liabilities, which is 80,800, with the total of non-current liabilities, which is 10,000, and then you add the capital of 64,000, which we have derived ourselves, you get total equity and liabilities of 154,800, or total capital and liabilities of 154,800. Okay, so this means that the accounting equation is balanced. Total of all assets equal to the total of all capital or equity plus the total of all liabilities. So 154,800. Right, so that's all for today's lesson. Make sure to like this video and subscribe to this channel. And if you need help with any other topics, post them down in the comments below. I'll see you in the next lesson.